Good morning, everybody. Welcome to the latest edition of the Reuters Events Commodities webinar series. This month, we're joined by thought leaders from Brady Technologies, the CME Group, the LME, and Human Capital. We're going to be covering global metals and looking at the global metals outlook for 2021. I wanted to begin by thanking our host today, Paul Chapman, Managing Partner of Human Capital and host of the HC Insider podcast, for helping us put this together. Over to you, Paul, and I look forward to the session.
Thanks, Marek, and thanks to our panelists. So we're joined by Carmen Carey, the CEO of Brady Technologies, Eric Norland, Senior Economist at the CME, and Robin Martin, Head of Market Development at the LME. So thank you for joining. The biggest topic, or at least the biggest thing in the media at the moment around metals and commodities in general, is the coming commodity super cycle, or even some argue that we're already in it. As Goldman Sachs noted at the beginning of the year, they believe this is driven by redistributive policies at the governmental level around the world, getting money into lower income families who will spend it, driving up demand for goods and services. Also, energy transition, the need to overhaul the entire economy, our energy economy around the world in response to climate change. And also, finally, the desire to find more versatile supply chains in the wake of COVID, and also 2 years of a global trade war. I guess over to you, Eric, as our economist. Are we indeed in a commodity super cycle, a macro shift up in commodity prices over the next 5 to 10 years?
Yeah, I think it's a remarkably difficult question to answer, in part because I think first requires a definition of what the commodity super cycle actually is. The kind of standard definition I was always familiar with up until the past few months was that you're kind of always in some sort of a super cycle, where typically you have maybe a decade of incredibly rising prices like we had during the 1970s, or in a decade between 2000 and 2011. Sometimes that's followed by a decade of falling prices like we had during the 1980s and like we had again during the 2010s. Often followed by a decade of sort of consolidating prices like we had during the 1960s or the 1990s. So in the last few months, people have sort of taken this sort of commodity super cycle idea, and they seem to really focus on the bull market aspect of it. So do we see this incredible lasting uptrend in commodity prices, and what might that look like? Well, if you look at the last two ones, the one in the 1970s that took, say, the price of gold from $35 to $800 per ounce, or the most recent one, that kind of began in the late 90s or early 2000s and peaked out in 2011 or 2008, depending on the commodity. It took a lot of prices up 300, 400, 500%. I mean, do you really see prices going up 300, 400, 500% between now and the year 2030? I find it a little hard to believe for a couple of reasons. First of all, this most recent commodity super cycle, or at least bull trend in commodities in the first decade of this new century, was really driven by the emergence of China as a gigantic global economy. As a gigantic portion of the global economy as a driver of global growth. China is now slowing down quite a lot. They've taken on a tremendous amount of debt. The Chinese economy has done very well in the past few months, which has driven up commodity prices. But I think China's economic strength in the last few months really comes down to just a couple factors. First of all, because people have not been able to spend any money on any sort of experience, like travel, for example, or restaurant meals. They have instead been buying a lot of manufactured goods. And so that's created a lot of demand for metals. And then secondly, China's also taken on a tremendous amount of debt. Their debt level with respect to GDP was 250% a year ago. Now it's around 290% of GDP, combining the public and private sector. So to kind of restart their economy, they took on a tremendous amount of debt. And of course, China's not unique in that regard. The US, Western Europe, Japan have all been doing the same thing, although typically in these other countries, more in the public sector than in the private sector. And so now what you're seeing is you've seen this kind of devaluation of fiat currencies versus real assets. So that's also created a lot of interest in metals, particularly in precious metals as a way of hedging that. that potential inflation risk going forward. But to my mind, are any of these things really long-lasting trends? I mean, China has tremendous demographic headwinds. Are these kind of stimulative policies going to last an entire decade? So I'm a little skeptical when I think of this idea that we're going to have this decade-long bull market in prices. It seems to me maybe more likely we're going to have a decade of consolidating prices, and we're now exploring maybe the upper end of a very wide range.
Sorry. Nevertheless, there has been some run up in prices over the since October. Are you seeing, Carmen, are you seeing an increase in activity in the space? And what's your take on what Eric has said?
Well, we're certainly seeing activity raising in the space relative to our customers, and particularly those who have franchises and metals that are supporting the energy transition, and some of the goods that Eric has referenced there in their need to expand and expedite supply chains and integrate more efficiency and operational effectiveness into their businesses. We're seeing customers, new entrants coming on board who are needing to ramp up systems very quickly. So looking for fast start programs to launch products to market within months, so rapid time to market. And we're also seeing a shift in our energy portfolio of customers and opportunities relative to the shift from traditional trading to the prompt market, which clearly is there's a connection there between what's happening in the energy transition, the sourcing of goods to support the decarbonization agendas, and building batteries, supporting electronic vehicles, dealing with the change in how the renewables markets are trading. So we're certainly seeing it in our day-to-day business, Paul, and we're seeing the opportunity to support our customers in responding to these shifts in demand.
Because energy transition, at least from a metals perspective, is at the core of this. Whilst there might be less secular run-ups in commodities like oil or other energies, it seems particularly, a lot of the focus has been on copper, nickel, cobalt, and in particular lithium, all of which I think will come onto this. The LME and the CME have certainly been involved in trying to build contracts around those. What's Robin, I know you can't give us market guidance, but what are you seeing at the LME with regards to this commodity supercycle?
Yeah, look, I think to echo some of Eric's comments, I think the jury on a commodity super cycle is perhaps still out in terms of what that means for prices. But I think the energy transition that you've alluded to will undoubtedly transform the demand and supply equation, not just for the metals that are sort of commonly referenced in the media around electric vehicles demand, the likes of cobalt and lithium, but even many of the core traded LME metals today, be it copper, nickel, will see their demand profile impacted very significantly in the coming years. Maybe just to put some stats around it, nickel is often referred to within the sort of EV battery complex, but today, less than 10% of nickel demand is actually linked to EV manufacturing, and this is going to grow very, very significantly. Nickel demand in that segment is growing at 30-40% every single year, and the impact is going to be such that by the end of this decade, we might see a doubling in total nickel demand. And then if you look at the more specialist materials and metals, cobalt, lithium, that's where you're going to see a completely different picture, right? These are, in absolute terms, still very, very small markets, and so the impact from the growing EV wave is going to, in many cases, quadruple the physical demand in a short number of years. So that, if nothing else, is going to create a very volatile pricing environment. And you saw that, I think, in lithium and cobalt 2-3 years ago. You had a massive run up in price because a lot of these growth expectations were being priced in, And then when the demand didn't quite materialize at the rate expected, very quickly you had a supply overhang, which caused prices to come down by almost 2/3. So this is going to continue to be a volatile space, and that's why we have a lot of people coming to the LME and interested in exploring risk management, hedging for new products such as lithium.
And I want to come on to, in particular, kind of the EV metal suite and the products around that in a moment. But I think you touched on something there, Robin, because one of the things that this is driving at the moment is both institutional investors and, well, hedge funds, other traders, other trading entities coming in and wanting to get involved in commodities in general and metals in particular. Are we seeing any of that? I just guess to you, Carmen, are you seeing a different type of client come in? Outside industry traders coming in wanting to get involved in the space simply as a result of the dare I say it, the hype at the moment around commodities?
We haven't seen a huge shift yet, Paul, but I think we're starting to see that interest build, the questions coming in, the inquiries coming in, and people wanting to talk to our teams about what this means and how Brady can support. So I agree with my colleagues on the call here. I think it's the beginning of the wave of people starting to understand what the opportunity space looks like, who aren't traditionally operating in that space now.
Yeah. Because one dynamic here, Eric, and I perhaps go to you on this, is we could see significant inflation, which, there's a lot of bond funds out there. There's a lot of need to hedge relatively low coupon rates. That could really drive a commodities super cycle. How could that mechanism start to enact in commodities, and what would that actually mean for metals in particular?
Well, I mean, if you look back at the last period in which we had really high consumer price inflation during the 1970s, it was perhaps the best decade in the last century for metals. Now, some of the metals prospered because they'd been held at artificially low prices. I mean, for example, gold had been fixed at $35 an ounce, and when that kind of came off of its peg at the end of the 1960s, gold prices immediately went to 180. We don't really have those kinds of things operating right now, but even if you looked at industrial metals in the 1970s, you saw phenomenal gains in prices as people turned towards real assets as a means of hedging their inflation risk. And I think the metals offer, in some ways, a really attractive way of doing that because they're relatively inexpensive to warehouse. Unlike petrol, which is expensive to warehouse, or say natural gas, which is extremely expensive to warehouse, or agricultural goods, which eventually go bad if you leave them in the grain silos for too long. Metals always maintain their integrity and they don't change. And unlike real estate, it's not really subject to the negative impacts of rising interest rates. With rising inflation, you typically get higher bond yields, which increases borrowing costs, which makes real estate not so attractive. So in some ways, in a rising inflation environment, metals are almost the ideal asset class to hold. And that was really the case in the 1970s. But I do think it's a little bit early to say whether or not we really are going to see a rise in inflation. I think people are correct in saying that we are starting to see policies being enacted around the world that are boosting income at the lower levels, which is a big change from the sort of focus on supply side economics that we've seen. But what I would warn people about, though, is the global economy still seems to have this enormous capacity to meet demand. That hasn't been maybe as true in the last few months as we've been having some of these short-term supply glitches with containers and things like that. But when you look at metal supply, I think that's the other thing you have to focus on here is when you look at the mining supply of metals, copper mining supply is twice as great now as it was in 1994. Our ability to produce aluminum, iron ore, steel has more than tripled. And now we have this another wave of very high prices, potentially incentivizing a great deal of investment. Now, that investment may not come to fruition in terms of higher production for maybe 5 or 7 years. But by the time we get to this end of this decade, if prices were to remain high, we could see a lot higher levels of mining and metals production.
That part of that super cycle narrative of high prices fix high prices. Robin, are you seeing even at this early stage, potentially any desire to store metals or invest in metals as an inflationary hedge?
Well, it's interesting, actually. You know, in some cases, with all the talk of super cycle and the, I guess, very substantial run up in prices that we've seen since the lows of last March, it's peculiar in some ways that institutional investor interest and the discussions we have with funds isn't that pronounced. I mean, clearly, the types of investors who would always keep an eye on commodity markets. Global macro funds have been quite active in the metal space, as have been the specialist funds that always play in this space. But we haven't really seen the sort of broadening of interest that we saw in the early 2000s. Certainly, that's reflected in the conversations we're having with market participants. In some ways, it appears that the volatility that we saw last year actually caught out a lot of funds, and they actually had to dial back a lot of the risk capital that they committed, and we're sort of slowly starting to see that come back in. But it's not just on our market. Even if you look at other market proxies for investor participation, flows into exchange traded funds don't suggest that investors are widely participating in the metals run. Precious metals are different. Obviously, gold ETFs have seen massive and more recently outflows, but that's a slightly different dynamic to industrial metals.
Yeah, thank you. One of the things you mentioned there, Eric, was the capacity of the miners to ramp up production, and a lot of latent capacity there. That's not necessarily true of a number of these metals required for energy transition. I'm thinking in particular the rare earths, albeit very low volumes, lithium in particular, where there's limited supply, very limited chemical processing. Some issues similarly around cobalt as well, particularly in provenance, which will come on to, I guess, ESG factors. But what are each of your organizations doing in terms of providing new products or new services around those particular metals, where I think the expectation is we are going to see probably a significant run up if the EV projections are held to. Maybe, Carmen, can you perhaps talk to Brady Technologies actions to prepare?
Sure. I think I'll certainly come at it from a software vendor perspective, Paul. And I think there's probably a few fundamental principles just in general, irrespective of product, that are important that technology providers embrace around automation and integration. So making sure we're enabling interfaces to apps and services to minimize the data duplication and optimize the speed of data. I think getting to real time in terms of automation and integration and being able to understand risk in real time is absolutely key to ensure you have the best possible opportunity to make the best trading decisions. Adopting Agile and DevOps in terms of getting capabilities to customers as quickly as possible. And of course, cloud, not a new topic, but having flexibility in your deployment options and scalability is absolutely key. And two other, I think, points that I think coincide, that standalone, but also probably coincide somewhat with the pandemic and where we are today, is the importance on security built in. The more the systems need to be connected, the more we need to ensure the integrity of the data and the security around them. And given that remote working and mixed working environments are probably here to stay even after we move through the worst of the pandemic, thinking about remote deployment and optionality around how you service your customers within your business in this trading environment is absolutely key. In regards to the metals products, and Brady, as many people will know, it has a long heritage in metals. You know, we're able to support these product lines very, very well, and we will continue to enrich our functionality on those levels. I think that the key thing for us on the metals front is the efficiency and effectiveness we can bring to our customers in terms of helping them optimize their supply chains and bring their new products into their businesses through services and fast start programs, and making sure we're doing everything we can to meet their demand. And from an energy perspective, we certainly see a big opportunity to support the transition to the prompt market, where traders are going to have to change the way they trade as decentralization changes the way that the markets operate. And we're moving from traditional ETRM approaches to real-time trading. There's an entire shift there that we're seeing, and we're building a whole platform around that to support our customers and the market in terms of making that shift from the asset developer side to the trading side of the spectrum. So I think there's a lot that, whether or not you're using an external vendor or you're doing your own IT in-house, there's a lot to be done to think about optimization, effectiveness, and how you create the best possible data flow within your business securely and at speed.
Yeah, and I absolutely. I want to come on to digitization next, but just one final piece on I guess the super cycle. It sounds like the general consensus is we don't know yet. There's plenty of headwinds as well as tailwinds. But they're just staying on these EV metals. Obviously, the CME and the LME have cobalt contracts. The LME are launching a lithium carbonate contract, I think, in June. Can you perhaps, Robin, can you just give us a couple of sentences on that and what you feel the uptake is? Because that's still relatively an esoteric product, I think, to many out there.
Yeah, that's right, Paul. So we're launching a lithium contract in the middle of June, and really this is off the back of a multi-year market engagement process, and it's something where we're really excited about. As you say, it's early days in this market, right? Are we going to get very rapid traction around this contract? I think that remains to be seen. But we're looking at this very much from a long-term perspective. We have a fantastic advisory committee that comprises participants from across the full value chain who've provided invaluable support in helping us define the contract specifications, and we've worked extensively with our price provider. So this is going to be a cash settled futures contract rather than a physically deliverable one. So we've worked a lot with Fast Markets Metal Bulletin to get the industry to adopt fast markets prices in their physical supply contracts. Of course, that is a prerequisite for any futures contract to gain traction, and we've seen some really encouraging progress around that over the last couple of years, which I think puts us in a nice place for hopefully capitalizing on growth in, as you say, small market today, but with a very significant growth potential behind it.
Yeah, I was reading somewhere that I think lithium demand is expected to outstrip even the most optimistic forecast of supply by double by 2030. So it's obviously got significant demands there. So moving on to digitization and staying with you, if we can, Robin, there is an opportunity and a demand out there for the commodity markets in general to digitize, providing more compliance, lowering costs in trading, increasing transparency. The LME has just done digitized all warrants. It sounds relatively simple on the face of it, but it's complicated in practice, as I understand. Can you just talk to Robin, what is driving digitization in the commodity markets? What does it mean to the LME?
Yeah, look, digitization is a key strategic priority for the LME. I think at the very latest, so since the pandemic, which has undoubtedly accelerated the case for digitization, and I think really woke certain organizations out of a degree of complacency. There's a dawning recognition that particularly in commodities, the old established ways of doing things are really ripe for disruption. You mentioned digitization of warrants. That's a good example, in my view, something the LME has done. Earlier this month, we went live with, if you like, electronifying LME warrants, which are the bearer documents that give entitlement to physical metal. On the surface, you would think that's an easy process because just build a database and store electronic records there. But it's really once you understand some of the underlying complexities. In this case, we had to seek legal opinions in dozens of jurisdictions, each with their own legal frameworks around what is permissible, which in turn then has implications on how you design the systems, the processes. Very quickly, you see that there are complexities and challenges to be overcome. But this is an example where we're incredibly pleased with the outcome, because it's going to make the whole market more efficient, right? You're no longer going to have couriering of paper documents around the City of London. It's overall just a quicker, more efficient process for everyone involved in the warrants market. And crucially, it cuts out operational risk as well. So, that's just one example of a digitization initiative. Perhaps another one, which we've been quite public on, is a system called LME Passport that we're currently in the midst of developing. The idea here is to create a digital register for metals metadata. So in the first instance, we're going to electronify so-called certificates of analysis. These are the traditionally paper-based documents that describe the chemical composition of a unit of metal, and these documents are printed, scanned, and faxed around the world, and it's just a hugely inefficient process. So the idea is, in future, producers will register this information into our system at source, and then it can be tracked readily and easily across the supply chain. And obviously that then also gives rise to future opportunities to register things like ESG-linked certifications, disclosures. By way of example, the carbon footprint linked to a unit of aluminium, for example, can be tracked in a very robust and secure way from source through to downstream consumers. So these are just some of the examples we're looking at in the digitization space.
And I want to touch on one point you made there, and we'll come on to that ESG, sort of the attributes that we can capture later on. But to you, Eric, Robin said there, you're ultimately increasing the efficiency of the market. Digitization itself is, commonly associated with transparency, price discovery. We've had a couple of years of the metals traders, having significant years and great success. Part of that is because it's a more challenging market around transparency and price discovery. Does digitization reduce the trading opportunity over the long term, Eric?
No, I don't think so. I don't think in any way it would reduce the trading opportunity. I mean, we've had, if I'm not mistaken, I think we've had electronic warrants on the exchange since 2007. I don't think that that's really, in any way, reduced trading opportunity. I don't think ultimately the trend in prices, which I think is probably what most people think of when they think of trading opportunity, or price is going to go on an uptrend or a downtrend, I think is what most investors are ultimately interested in. I don't think that really changes because the price discovery mechanism becomes more efficient. If demand for a metal increases over the long term and supply doesn't increase as quickly, the price is going to increase. But it may be more responsive, or may do so in a more efficient manner if you have more efficient trading systems.
The other aspect touched there is, and perhaps you, Carmen, is the metals markets have had a fair few stumbles over in the last couple of years, over ultimately either whether it's been compliance or whether it's been missing materials, which in turn can affect liquidity as financiers will pull out or are less willing to support trades. Where do you see digitization supporting compliance and therefore liquidity. I think this pertains probably more to the OTC markets, the B2B side, necessarily than obviously the closed loop of the LME, for example, or the exchanges.
Yeah, I think the themes are quite similar, Paul, in terms of the controls that can be built into the systems and the seamless transfer of data between systems. So there's a clear traceability point in terms of source and endpoint. I think that the more we understand how we can enable that transparency within the software and within the processes, the more we can enable the optimization of the commercial outcome for everyone in the supply chain, or everyone in all the stakeholders. So I think for us, it's about continuing down the path of some of the things I just described, but also I think the connection to ESG is unmistakable relative to compliance and governance and how those controls are coming into play and what that means for operators as well as vendors and exchanges in regards to how we collaborate together. I think this will be a wave of greater collaboration in terms of opening up the discussions and understanding how we whole problem solve across all elements of this ecosystem. Because it can't be done in isolation. And I think that's, if it remains in isolation, it won't get us to the place we need to be relative to overcoming the compliance challenges or the efficiency challenges or some of the initiatives that Robin has talked about in terms of digitization, I can't even say the word, of capabilities from an LME perspective.
And I think a question that's definitely out there is, with digitization comes the opportunity for platforms to talk to one another. There's a number of platforms or startups out there, applications that are essentially using shared ledgers, blockchain technology to allow, I guess, that verification, that reduce costs at the post-trade side of things. Lots of them out there. A lot of them can potentially be hugely disruptive to the way the traditional trading markets operate. Robin, does the LME see these startups as rivals or as potential partners, and what's the view there?
Well, all of those things, right? Rivals, potential partners. We're in discussions with many of them, but overall, we'd see this more as an opportunity than a threat. Clearly, if the physical markets, in terms of how they trade, become more transparent, more efficient, then ultimately that's good for commodities trading overall, and we expect will drive increased need for risk transfer, hedging, etc., back onto derivatives exchanges like the LME, right? So what's good for the commodities market as a whole, digitization of outmoded processes and practices, I think ultimately is good for the LME. But I think more broadly, there are interesting opportunities for exchanges like ours to partner with those upstarts, right? And we're very much in discussions with various commodity consortia who we think are working on interesting things. To your question, will these upstarts sort of disrupt the role of exchanges? Personally, I don't think so. A big part of what exchanges bring is a venue that is trusted by market participants, and I know that a lot of people are quick to suggest that that the trust factor can be delivered by a blockchain ledger. And a lot of the rules and the controls could be automated through the likes of smart contracts, and all of those things are real, if not necessarily practicable today. But I think it neglects the fact that as important is you need some central authority to set the rules, the standards, to enforce the controls, and that's where exchanges have a very important role to play. But then also, those very same technologies, I think, can be can be leveraged by exchanges, right? So we'd be negligent if we weren't looking at the applications of DLT in terms of how we operate our business today. So, in short, more opportunity than threats, I think, from the LME's perspective.
Carmen, you've mentioned a couple of times this drive to the prompt market, the kind of the increase in the velocity of trading, and I think alluding to perhaps on the energy side, particularly with power. If you've got these mega factories or virtual power plants balancing load and so forth, does that automatically drive the need for parties to talk to one another, systems to talk to one another without necessarily human intervention? Will that drive this trend?
We think it will drive this trend, absolutely, Paul, because the shift to the prompt market means that everything has to happen in real time and near real time, which means systems need to talk, and the people need to have access to information in real time to make good decisions, which means they have to be able to understand the current position, what's happening in the markets, how they're going to react, that they somehow have to patch together. I think it will change the way trading operates, and it will open up the opportunity, as Robin said, for more upstarts and modern technologies, contemporary capabilities to be introduced into the market, whether that's leveraging big data, AI, greater visualization capabilities. I think it's quite an exciting time for the market and the exchanges to look at how they optimize together. So we think there'll be a movement there, and we think it's quite an exciting time.
Excellent. Eric, the CME's view?
Yeah, I would just add a couple of points. I mean, first of all, when transaction costs come down because new technologies make things more efficient, that facilitates additional trading. So, as transaction costs have been on a downward trend for a long time, as trading systems have become more and more efficient, as we've moved away from floor trading to electronic trading, et cetera. And we've seen this tremendous uptrend in volume as a result of that. Sometimes there are resistance to changes, but then once the changes are implemented, people discover they like the new way of trading because it's so much easier than old ways of trading. So, I'm quite optimistic that these sort of adjacent technologies that are kind of moving alongside exchanges are probably going to be very bullish for volumes over the long term. In addition, I'd like to add just one thing to a point that Robin made, which I think was an excellent point, which is that it's still important to have central authorities setting policies and standards. That helps to build trust, of course, and maintain trust in markets. The other thing why I think exchanges are not going to lose their roles in metals is that they provide incredibly deep pools of liquidity where people can come into the market and know that there will be somebody on the other side of the transaction, hopefully at a nearby price to take the other side of the deal. And liquidity pools historically have been very difficult to move. So I think that that's also another reason to be optimistic about the sort of role of exchanges in the metals business going forward, even as we go through a more and more rapid technological change.
Talking of lowering transaction costs and digitizing, Robin, is obviously the end of, or the open outcry is under discussion. Is that part of this trend or something different?
Yeah, I think that's something different in some ways. That is us looking at opportunities for modernizing and reforming our market more broadly. Naturally, the current backdrop of the pandemic, which has forced the ring closure. The ring has now been, our open outcry floor has been closed for the best part of a year. And as many of the viewers will know, that's prompted us in part to put out a discussion paper to seek feedback from the full breadth of the market in terms of whether or not we close the ring and introduce other market structure reform measures.
Thank you. So moving on to ESG, and I think we'll talk about liquidity because that's a key part of this as well when you start adding in attributes. At the moment, we have stakeholders demanding it, investors applying a premium to those organizations that have clear plans and goals, and a discount to those that don't. So there's a lot of drivers out there. Where does, not least from employees as well, from being in the talent side of things, there's also a clear need for both graduates, but also existing employees to feel that their organizations are tackling this subject. How does each organization prioritize ESG? Carmen, perhaps we can start with Brady Technologies.
Sure. So yeah, there's no doubt that the ESG standards are ubiquitous and here to stay, it would appear, and the momentum is building. We're a privately held business. Our investor, our major shareholder, subscribe to the UN responsible investors principles. So clearly embracing ESG, as are we. We've taken steps to become a carbon neutral organization, so to kind of lead from the front in terms of actions we're taking as a business. And I think that as a from a software vendor perspective, I think the critical thing for us again is to understand what this means for our customers and for the shift in the market relative to some of the trends we talked about, because I think all of these things are quite interrelated. And make sure we understand, the key themes, how we respond to the key themes and are responding to the key themes around traceability, data-driven supply chains, logistics, distribution, green mining, and the topics around the ongoing energy transition and how that changes the way we bring products to market, but also how these products are consumed. I think that it's important that we work with our customers to understand their agendas, because ESG and business performance and profitability can't be mutually exclusive. And I think that's where the fine dance is how much can everyone invest in this and retain their business performance levels, because this is a cause for good, I think we all believe, but we also need to understand how we manage the transition to some of these standards.
Robin?
Yeah, look, I think most viewers will know sustainability is a huge topic for the LME. Last summer, we published a very comprehensive sustainability strategy, but our work in this space really goes back quite a number of years. By way of example, the work that we've done around responsible sourcing, I think is a very important step. And I think an interesting case study as well, because when we first started the work around this, it's fair to say there was quite a lot of industry pushback from certain quarters. Questions were raised as to, is this really the role for the LME to play? Why are you doing this? Does this run the risk of fragmenting of the market? What are the unintended consequences? And just now, 3-4 years later, I think there's a very strong consensus that we absolutely took the right steps in taking an industry leadership role there to promote that agenda. Now, clearly the market can only move so fast, right? In responding to new standards, to new requirements. So we are introducing things at a measured rate. Some would say still too fast, and it's creating a lot of headaches for people upstream in the value chain. Others would suggest we're going about it too slowly. So there's an inherent tension there, but I think we're absolutely on the right track. Ultimately, the whole topic of the ESG, I do think, has to be consumer led, right? Consumers set the expectations as to what they want, and then the LME will try and play a supportive role in providing platform capabilities and introducing standards, mechanisms to really to fulfill those needs. And the LME passport system I mentioned, I think is a very good example there. At this stage, we certainly don't see ourselves as the standard setter of what constitutes low carbon aluminium, by way of example. So, because there isn't a universally accepted standard as of today. So we're providing a platform where producers will be able to register certifications, disclosures, complying with any number of standards, with all the relevant audit documentation that gets registered on the system. So at least it plugs the current difficulty where a producer might be compliant with a certain standard, but that information can't be readily accessed by the consumer. And so, as I think you plug some of these operational issues, over time that provides the platform for what I believe quite naturally will be the development of industry standards around a whole range of ESG considerations and criteria. So there's undoubtedly a lot going to happen in this space within the next few short years.
Yeah, thanks for that. And I think we'll touch again on digitization, the ability to put these attributes in, because that does have impacts on liquidity as well if you're starting to slice and dice these contracts. Eric, to talk on the CME, I know you have a number of sustainable products on your exchange. Obviously, the latest one has been the global emission offsets, these geo contracts. What's been, that's been a big initiative for the CME. It's been well publicized. What's actually been the uptake?
Well, I think that we've seen a lot of early customer support for the new geo futures, and I think that Robin is right. It really is very much led by demand, by consumer demand, and we're seeing a tremendous demand for decarbonization. And so what the geo futures will help to do is to allow people to establish a global pricing benchmark for voluntary emissions offset market. And so I think it's seen really strong interest from clients, and I guess we'll see what happens with volumes. I'm not sure what will happen with the volumes, but I think that it's definitely attracting a lot of interest. We also have a number of other products on the exchange. So you mentioned a cobalt future briefly earlier. We also have used cooking oil futures, and then we also have the ESG future on the S&P 500. So there's kind of a cross asset class approach to meeting these new customer demands.
Staying on carbon, because I think it is a very complex subject, and whilst it's certainly consumer led in terms of demand, the real challenge is, I think, on the providers of these contracts around verification, and actually sort of ensuring that they are doing what they say that they do and then meeting these standards. How does the LME and the CME, or does any exchange, thread that needle in terms of applying what standards to apply and verification and so forth, like for example with your geo futures?
That's a good question. You'd have to pose that question to somebody else in our organization. I work as an economist, and so I kind of follow what the demand trends are for different futures, but in terms of the contract specifications and things like that, I can't really go into detail, I'm afraid.
Carmen, I know you mentioned earlier sort of the need for verification and trust and provenance. How does that play into building into a platform, for example?
Yeah, it's a good question. I think that it's all about going back to what we can build, as you said, within the platform across a number of areas that are important for the traceability, whether that's logistics, manufacturing, environmental, the context around the financial trading to confirm people are ESG compliant. I think these are all capabilities and functionality that is now inherent in systems that we need to make sure that people are adopting and using properly. So I think that software plays a big role in enabling this verification process on a number of levels.
Robin, I know this is something that's been close to the LME with regards to low carbon contracts, about actually, what are they actually, how do they actually function in the market out there? Are they just pushing carbon elsewhere? what's I guess your thoughts around just carbon in general and these real challenging, complex subjects of verification about exactly how much good they're frankly doing.
Yeah, I think you've raised two separate but related questions, right? I mean, one is around pricing, right? And how do you price these things? And you mentioned the risk of market fragmentation and dividing liquidity, right? And so as an exchange, that is an important consideration for us, right? So do we think there is the market appetite or the depth in market size to support a liquid on-screen tradable low carbon aluminium futures contract today? No, we don't think so. That doesn't mean green as a category doesn't warrant being tradable on a futures exchange. I think many of our scrap or recycled contracts, and we're launching more contracts in that suite and that space in June, absolutely do have the critical mass. But for something like low carbon aluminium, the approach we're taking there is to say, okay, this is still quite a small market in absolute size, but one with growing interest. How can we best help the market identify what the sort of price premium for low carbon metal might look like? And so, we're looking to move that onto a physical spot trading platform where you can have bilateral spot transactions taking place, and you can generate a price index based on observed physical trading activity. So that's something we're looking to do there. But you're absolutely right. There's a key question around, well, what constitutes low carbon metal in the first place? And we don't see it as our role to sort of be the arbiter of truth and say, it's this many metric tons of carbon per ton of metal. There's different views on this. So we're working very closely with the various standard setters around the world. And as I say, we're going to give producers the choice to choose the standards they want to comply with, and then register that information in our central system, LME Passport. And over time, I think we're going to quite naturally see where there is real traction in the market.
And are you seeing that demand right now from the producers? Is there a growing demand out there for these kind of products?
Yes, absolutely. I mean, from the producer side, clearly, if you consider yourself a low carbon producer, you've got a differentiated product offering, then you want to be able to monetize that. I think that's only natural. And then likewise on the consumer side, particularly with some of the large car companies, we're definitely seeing strong appetite for shifting towards greener metal. But that comes with a lot of caveats, right? They want to make absolutely sure what they're buying actually meets the internal criteria they have, right? And I'd say it's still very early days, because at present it's not entirely clear whether, and if indeed how much, consumers are willing to pay in terms of a premium for metal that complies with certain standards.
Yeah, which I guess, to wrap up, brings us almost full circle in that, it's digitization that's going to provide that verification, or at least it seems the panel agrees on that is the direction that we're going. But again, coming back to the potential of a commodity super cycle, there's lots of reasons for, but it's not a fully baked situation right now. But clearly, irrespective of whether the broader commodity sector does have a big rise up in prices, there is this belief from everyone here that energy transition is happening. That there might be differing views on rates, but that will impact certainly the metals markets with respect to the likes of copper, of course, but particularly lithium, cobalt, nickel, two of which the LME and the CME have provided new contracts for, in the recent past or soon to come out on the lithium side. So I want to thank everyone, for their time, and yes, it was a fantastic discussion.
Thank you.
Thanks for having us.
Thank you.
Thank you so much for joining us. You just tuned into the Global Metals Outlook for 2021 panel with Brady Technologies, Human Capital, CME Group, and the LME. Thank you to all our panelists. We so appreciate you taking the time out today. And I hope to see all four of you very soon. And thank you to all our attendees. I hope you enjoyed the session.